Hey guys, welcome back to the channel. This is going to be lesson 2 in Macroeconomics with Grogu, and we're going to be going over money supply and interest rates. What is money supply, interest rates, and how they both impact the markets. So let's jump right in. What is money supply? Money supply is a measure of total amount of money in circulation in a country. There are various types of money in the money supply, and they are classified as M0, M1, M2, and M3, which is sorted by liquidity. In the United States, the Federal Reserve measures these. So let's go over that one more time. The money supply is just the total amount of money. So whether I have it, the bank has it, whoever has it, that's counted in the money supply. The M0, M1, M2, and M3 are just different types of money, and they're sorted by liquidity, which refers to the ease with which an asset can be converted into cash. So obviously, the most liquid asset is just cash itself. The next, if you could think of like a less liquid asset, would be something like a house that's very illiquid because you still have to sell the house to somebody else and then you can get the cash, but it's still considered an asset. Let's just go over M2 and M1, which is nowadays what we really focus on. M1 includes coins and currency, so just cash more or less. Checking accounts. So your checking account is included in M1, and traveler's checks, which no one ever really uses anymore, but it's still included in M1. M2, which includes all of M1, adds on top of that saving deposits, money market funds, certificate of deposit accounts, and other time deposits. So basically just other bank accounts, but they're less liquid because it takes more time to get the money out of the bank. When I refer to money supply, I'm going to be referring to M2 from now on because this is really the measurement we use. So who determines the money supply? In the United States, the Federal Reserve is the institution which controls the money supply by being the central federal bank where all the money is borrowed from. So you can think about it. If you're a big bank like Citibank or TD in the United States, where do you get your money from? You go to the Federal Reserve and you take out a loan from the Federal Reserve. So the Federal Reserve is really the big bank in the United States. Just like any other bank, the Federal Reserve charges an interest rate on this borrowed money. The higher their interest rate, the less money will be borrowed, and vice versa. Right, so if you go to the bank and you want to take out a loan, but the interest rate is something absurd like 50%, you're going to take out less because you're going to owe more and more each year because the interest rate is very high. But if the interest rate is something very low, like 1%, or even sometimes nowadays 0%, the money, you're going to take out more because you're going to owe less each year, right? It's kind of simple. Hopefully that makes sense. But let's just talk about it one more time because it's very important for what we're going to get to next. So the higher the Federal Reserve interest rate, the less money will be borrowed because it's more expensive. The lower the Federal Reserve's interest rate, the more money will be borrowed because it's less expensive. And because the Federal Reserve is the one lending out new money, if more money is borrowed from them, the bigger M2 gets, right? Because the Federal Reserve is taking out the new money and lending it out to people. If people take out more money, the money supply, the amount of total money in the United States will increase, therefore increasing M2. So which one increases M2 more? Lower interest rates or higher interest rates? Lower interest rates because people are more likely to borrow more because it's less expensive. So why do we care? If more money is being borrowed, then that money has to go somewhere. Very few people just take out money from the bank to just let it sit on your desk, either spending it or investing it. And in particular, large institutions, that somewhere happens to be the financial markets. They invest in real estate, which we're not going to be talking about, but we're going to talk about the stock market and cryptocurrency markets, and they also invest in that. So the lower the interest rates, the less expensive borrowed money is. We've already talked about that. But because it's so less expensive, the more risk on you'll likely be. So you're likely to buy risky stocks, risky cryptocurrencies, things of that nature. And the higher the interest rates, that encourages risk off positions because you're going to owe more each year. So something like gold, or even just holding it in cash, or just really big companies like Apple and Facebook, those are considered risk-off positions nowadays. So just to make this clear, this is macro. This phenomenon of lower and higher interest rates dumping the market happens over months, if not years. This is not short-term. Short-term market reactions after FOMC meetings are more to do with expectations. And we can go over that right now about how we can take advantage of that. So short-term predictions after the FOMC meeting. To make a prediction about how the market will react after the Fed announces their interest rates, we must look at others' expectations. I'm going to link that down below. There's a website that shows you really good, accurate what big banks are expecting the interest rates to be, and we can take that and we're going to use that in an equation later to take advantage of. So if the interest rate is lower than institutions' expectations, then the market is more likely to pump and vice versa. Once again, this is very short term, like a week or two after the FOMC meeting, right? So calculating the expectations. Example. So let's just say Bank A expects a 0% chance of at least a 50-point hike. At most, typo. Bank A expects a 0% chance of at most a 50-point hike, 100% chance of at least a 75-point hike, and 30% chance of at least a 100% hike. So let's take that and get the real expected answer. So this involves some math, this involves some statistics, but I have the equation down below. So it would be 100% times 75. So it's a 100% chance of at least a 75% hike. So that's where these two come from, plus 30% chance of at least 100% hike. We don't put the 50% point hike in because this is already 100%, right? So it's pretty relevant because this would be a 100% chance of at least a 50-point hike again, and it would just get canceled out. It's irrelevant. But I just wanted to include that there because the website does include that. So 100% times 75 plus 30% times 100 divided by 100% plus 30%, which is the 2% right here. And that comes out to 105 divided by 100% plus 30%, right? We just did this math. And that equals 80.77, I rounded a bit, point hike. So that's their real expectation. So their real expectation is an 80.77% point hike. But remember, the Fed's only going to do a 75 or 100% hike. So it's not going to be 80.77 because either answer is not going to be their real expectation. So this is how we can exploit it. If the Federal Reserve announces that they're increasing interest rates by 75 points, then by our real expected value calculation of 80.77, this is lower than expected. So the market is most likely to pump. If the Federal Reserve announces that they're increasing interest rates by 100 points, by our real expected calculation of 80.77, this is higher than expected, so the market is most likely to dump. Hopefully you understand that. If not, just rewind the video. I know there's a lot of math involved. But I hope you found this video helpful. I hope you can learn about economics through this and maybe implement this, especially during the FOMC meetings. Hopefully this helps next time. I know we just had one. If you like this content, subscribe down below. I do streams almost every weekday. I'm going to be doing more videos like these. There's also a link to a Discord server down below with a lot of good traders there. It's completely free to join. Just come and chat and you can learn there. Also, I have a link to a Bybit link down there where it has 30% off all your maker and taker fees. So Bybit is a really good leverage trading platform for cryptocurrency. So if you're interested in that, click that link below, make an account through there, and you get 30% off your fees. Thank you all for watching. Hope to see you next time.